Welcome to the Growth Experts Podcast. I'm your host, Derek Colin. On today's episode, we have a very special guest. He is the co-founder and managing principal at Navidar, Stephen Day. How you doing today?
Fine. Thank you, Derek. Thank you for the invitation.
Pleasure. Awesome. So can you share with us and the audience how your role fits into the bigger picture over at Navidar?
Sure. Tim and I co-founded Navidar in 2009. And at that time, we were based in New York City. Our focus from day one was to focus on the middle corridor of the country. We call it middle market technology investment banking, focused on the middle corridor. In 2012, we relocated the firm to Austin, Texas to be closer to our clients as we focus on that diamond between Austin to Denver, Minneapolis, Cleveland, and back as a principal geographic coverage area. Although 40% of our deals are cross-border as well, so we do quite a bit of deal making around the globe.
Oh, awesome. Around the globe, huh?
Yeah.
Very cool, man. So when it comes to, like your investment thesis and your approach to, deal making in your portfolio, can you give us some insights?
Sure. I mean, one of the principal things that Tim and I set out to solve was for companies in the middle market having access to expert investment banking skill set, which has really traditionally been reserved for the very large bulge bracket firms like Goldman Sachs, where I came from, Morgan Stanley, where Tim came from. The smaller clients simply don't have access to that skill set, to the global relationships that those firms have. And so that was our intent to bring that to the middle corridor. And so Tim and I together, we lead the firm, we lead the strategy for the firm and set the focus for the firm. And that's what we've done. And we basically developed a model where we place very senior attention to a very small number of transactions and get outlier results for them, both in terms of valuation and the legal terms. And so we have found it to be a very good model for serving these smaller businesses, which haven't had the time to make the types, or haven't had the money to make the types of investments that large venture capital backed companies have. So we have typically come in and sort of supplemented what they might not have been able to do on the legal front, the accounting front, and really help them get prepared for a process, which then leads to great outcomes for them.
Oh, that's really good. Yeah. So what major shifts are you currently seeing right now in the M&A space?
Well, the biggest shift that we're seeing in the technology space, of course, is AI, and it's the one that everybody's talking about, and it's where all the money is, going right now to invest in AI. We do a lot in SaaS software. We've been software bankers for 25 years, and I would say that every single one of our SaaS software companies is actively looking at how they can incorporate AI functionality into their solution. But services companies, we've worked with business services companies for a long time. They're all actively looking at developing a service line, to help companies to adopt AI. So whether you're creating it or adopting it, it's really forefront in everybody's mind at this time.
Interesting. Are those your ICP, or are you industry agnostic, or is there specific targets that you want to help?
We mostly focus in the technology and technology enabled space. And so it could be an industrial manufacturing business that actually has tech or tech enablement. So the longstanding clients of ours is Proto Labs. They actually run manufacturing facilities, but they are very much on the bleeding edge of software infused into that manufacturing process to make it more efficient, to make it more automated. I mean, they were one of the early pioneers 20 years ago that really kicked this off at scale. And now you're seeing this being incorporated by many other companies.
Interesting. Okay. Has there been anything that kind of impacted deal flow or your growth strategy as of late?
Well, I would say that the sort of geopolitical unrest has created issues for our clients. Very specifically, the tariff policies introduced last year created some real disruptions. We had several clients who were sourcing materials and products from China, and that created real disruption for them. That has started to sort of sort itself out, but I think there's still a great fear that tariffs could come back any day. So that has been one thing that's created a real challenge. The stock market had high volatility last year, so that impacted how people were trying to view valuations. More recently, it's the onset of AI and the power of it, and that's really had an impact on stock prices across a broad range of industries. We first saw it hit the SaaS software space, then we saw it hit the legal space, professional services firms, and so it's really sort of begun to have a ripple effect throughout a number of different sectors. So that's been disruptive. And then just recently here with the war in Iran, with fuel prices spiking, again, creating uncertainty and, fears of an economic slowdown. So I think all those things are weighing heavy on the marketplace. A private equity firm recently told me that this is probably one of the most difficult times in terms of valuation, in terms of price setting. And I think that all of the things going on with AI, overall market valuations and volatility are just creating a more difficult environment for deal making. Having said that, we've kicked off the year with several deals. We're getting great interest for those transactions. So people do want to put money to work. And if you have a quality company, quality asset to sell, there are interested buyers in that for sure. There is money on the sidelines wanting to be invested, but people are certainly making sure that they do so wisely, where it's a business that's not going to be obliterated by AI or heavily impacted by it.
So when it comes to, sourcing and, closing deals, like what's working well for you guys right now and what's been frustrating?
Well, I think the one thing that always works well is we have a process that's tried and true, which is a great deal of prep on the front end, a great deal of creativity in terms of how we tell the investor story. We often say that our clients have great customer stories, but they typically are not in the business of telling the investment story. And so we help them to craft a really compelling investment story, help them to develop long-term financial plans, 3 to 5 years of forecasting, which most of our clients do not have. So, and then going out very selectively and strategically to a group of logical investors or acquirers and having them go through a very detailed due diligence process. So that for us has led to our 93% close rate. It's also led to us being able to get 89% of the earnout dollars paid out to our clients, after deals close. And so we've had a great deal of success with that formula. I think that would probably frustrate us the most right now is just the geopolitical, sort of unrest, globally, where it creates, uncertainty with respect to the valuation and appetites to doing transactions. So we'd love to just get back to a bit more of a normalized business environment, but most part, quality companies, there's an open market, an active market for them. Another part of that market is reps and warranty insurance on deals. That market's very much alive and available. That also helps to ease the closing of transactions. So that's been good. Bank financing requirements are tighter. The leverage of debt to EBITDA has been decreased. Interest rates obviously increased quite a bit. They've come back a little bit. But I think that with the ability to price in that into the overall value, knowing what the cost of interest is, knowing what the leverage is going to be, buyers can factor that in. What it results in is a net lower purchase price is the net result. But buyers can factor that in now and they can do business in that environment. So obviously if interest rates came down, if leverage freed up a little bit, that would help deal making too. But it hasn't closed the market for sure.
Well, that's good. Yeah. And when it comes to like myths and misconceptions in investment banking that, confuse entrepreneurs, can you kind of talk a little bit more about that?
Sure. I think the hiring an investment banker is very difficult. And I think candidly, most people, rightfully so, don't understand really how investment banking works. And so I think that one thing I would encourage entrepreneurs is to really spend a lot of time talking to other entrepreneurs who have worked with multiple bankers that can kind of help them compare and contrast. But one of the things that we think is really important for picking a banker is no different than picking a doctor. You want to look at where they were trained. You want to look at the pedigree. You want to look at the people that they studied underneath, right? Where did they do the residency? And that's the same in investment banking. The larger firms have really wonderful training programs. They have excellent expert investment bankers, and of course, those are the firms where Tim and I held leadership positions, where we grew our careers. And so we have a great benefit from that, a great deal of respect for that. I think the second thing is almost anybody can hold out a shingle and open up a shop for sell-side M&A. I mean, it's unbelievable to us that somebody will sell a company or sell two companies and all of a sudden they deem themselves an M&A advisor and want to go out and start giving M&A advice. And I can't tell you the number of times we've sat on panels next to these people who are just giving atrocious advice to entrepreneurs. So I think really discerning and being really critical in terms of where you're getting your advice, who you're getting it from, and really gauging their background and their expertise is really important. There's other things too to look for in terms of really expert M&A skill set, one is negotiation skills. And you get that from doing a lot of buy-side M&A. So look for bankers who've done a lot of buy-side work, not just sell-side. Another part is doing IPOs. If you're the book runner on an IPO, that means you're a really creative storyteller. That means you really know how to build great models for forecasting that companies live by. So look for those types of experiences in your banker. Those are really going to help you to have the types of skills that you want. And I think the final part is the cross-border. I think there's a perception that only global banks can do cross-border, which is absolutely not the case. 40% of our deal flow is cross-border. Now, if Tim and I didn't have the Goldman and Morgan background and experience and relationship set, maybe we wouldn't be able to do that either. But the fact is that we have it, and that's something we're able to do without any intermediary. So those are the kind of things where I think, people will look for, oh, I want a banker who did a deal just like mine. Well, that banker may not be the best skill at all. So be careful to just easily select, oh, I want a banker who knows all the buyers. Well, it's easy to contact buyers. That's not hard. 86% of our deals are done with buyers that we've never done a deal for. That's a 25-year track record right there. So most of the time we're closing deals with people we've never closed a deal with. That is just the truth of investment banking. So I think a lot of these things, they sound good on the face, but when you start to dig in, it doesn't really get to the heart of the skill of the banker.
Yeah. So when you talk about investment banking or investment bankers, when it comes to their deal flow and origination processes, you did mention one key aspect of it is look for buyer side. Can you elaborate a little bit more on that? And what do you want sellers or buyers to know before they engage with your firm?
Yeah, so I think that what I was meaning by that is, we did a lot of buy-side M&A where we would represent the buyer. And when you're representing the buyer, you're just one of many bidders, or perhaps you're the only bidder. You just don't know. You're not the sell side. You don't have all information. So then the negotiation skill becomes much more important. Being able to read a party, kind of set some negotiation traps to kind of in a conflict, to test their process. There's just a lot of things that you do as a buy-side M&A banker to try to understand how many people are in the process. What's the valuation range? What's it take to win this thing without overpaying? The whole goal is to pay the lowest price, right? And so typically when you don't have all information, you're going to default to paying a higher price, right? Versus really testing the valuation, testing the process. So that's one thing I think they should really look for. But I think that in terms of, looking for a banker that you want to work with, the first thing is integrity. There's a lot of aspects of investment banking that aren't on the up and up. And there's a lot of conflicts in investment banking. And so really ferreting out those conflicts and making sure your banker is truly conflict free is really important. I think that's number one, is just the conflict free and the integrity part of the banking relationship is really important. We have lawyers and we have clients who will want to try to negotiate certain terms in the engagement letter, which could put the banker at odds, with the client's best interest. And so these are important things to really think through. They sound like good ideas on the face of it, but then when you dig in, they're just really horrible ideas. We won't cross any of those red lines. We never have. I'll give you just one quick example as to what I mean.
Sure.
In an investment banking letter, there's a concept of a termination. And that termination period, survival period goes for, let's say, 12 months, where if somebody terminates you, if they do a deal within 12 months, they still have to pay you the full fee. That prevents somebody from taking advantage of the banker and getting a deal and then trying to terminate them and not pay. That's not controversial. What some people will try to do is say, okay, well, I'll only pay you over those 12 months during that survival period if that buyer is named on a list of people that you reached out to and talked to. So only if somebody you reached out to, you'll get paid on. Well, that creates a horrible incentive for the banker, because the banker incentive is to call 5,000 people and to timestamp as many names as they can to increase the probability of themselves getting paid. That might be a horrible idea for the client. That might risk confidentiality. That might waste a lot of time with tire kickers. And so we're all about quality. And so we only want to reach out to 5 or 10 people that are the highest quality buyers, right? See if we can get the outlier bid first. And so by the way that we do it, we put the client's interest first. And if you're a true partner and you do an excellent job for your client, if you had to reach that survival period, you would still have the client would still be incented to want to work with you. Now, we very, very ever seldom trigger that survival period. I mean, I can't even remember the last time we did, but it's important concept of never putting our economic interest against the client's interest. And so that's what you see a lot of times. Small boutique banks will start to compromise on these terms just to get the deal and to appease the client. And the client doesn't even then understand that the banker's really working his own self-interest, not in the client's self-interest.
Oh man. Yeah, that sucks. I mean,
And there's a lot of things like that that people try to do that, just don't make any sense. There's another term. I'll give you an example. A buyer approaches a company and has a term sheet. And so a client will say, okay, well, hey, if you do the deal with buyer A that I brought to the table, I'll pay you 50% of the fee. I'll pay you half of the fee. If you bring somebody else to the table, then I'll pay you a full fee. What do you think the banker wants to do? He wants to kill deal A, and he wants to do a deal with party B because he gets the fee. Well, the banker's not acting in your interest now. Buyer
Yeah.
B could be a terrible buyer. Could be a poor cultural fit, whatever. And so people do things like this because they think it sounds good, it sounds clever, but then the banker's not working in their interest to get the best deal. And I'll just say this is another myth in investment banking, that who shows up on your doorstep as your strategic partner. I've sat on panels and literally listened to people say, oh, if it's a strategic buyer who's going to buy you, they're going to emerge. This is going to happen naturally. There's never been a term sheet, at Navidar where somebody showed up early for a deal and then we got hired and we didn't increase the value of that, make that a better bid. And so my point is only less than 15% of the time does the original buyer, does the original term sheet survive a process. So my point is definitely run a process. It's highly unlikely that the first person showed up is going to be the highest bid, and definitely incentivize your banker to go and get you the best deal, which includes valuation, legal terms, cultural fit, customer, taking care of customers. I mean, all those things matter to most entrepreneurs. And so you want to find the best overall deal. So incentivize your banker to be indifferent to who buys is the point.
Yeah. If you were to eliminate something out of, I guess, your phases of, due diligence and who you would work with, what would it be?
Well, we probably select maybe 1 out of 10 clients that we meet to work with. And I'd say the first thing we're looking for is we're branded as doing differentiated deals. We don't do the most deals, obviously, right? But the reason why all the big cap guys and the private equity firms take our calls is because we bring interesting deals. They know it's going to be something novel, right, that we bring. And we like to do first movers. We like to do, category leaders. Like, these are the kind of companies that we like to sell. And so if you have that type of story and you're deserving of an outlier valuation, then we're the type of branded bank that you want to be in. We don't do traditional LTM EBITDA stories where you write a 100-page SIM and distribute it to 200 people and it's going to trade for 7 or 8 times EBITDA. Like, those are not the kind of stories that we do. Those are no-brainer stories. Junior people do them. We typically try to do really differentiated stories. And so I think that for us, we're looking for that. That's number one. Number two is we're looking for somebody who truly values a trusted advisor. I mean, often our clients tell us that our success fee percentage is the highest of anybody who they interviewed. So anybody who's trying to chisel that down, and we always say, look, you can't buy a Cadillac for the price of a Chevy. So if you want a Cadillac service, if you want top-notch service, then that's going to cost extra. The result is higher close rate on deals, higher valuations, more earnout dollars paid, better legal terms. I mean, that's the result of what we get. And that's been proven over and over with our model. And so we're looking for a client who truly values that and wants to be in a true partnership with us. So that means we don't really take changes to our engagement letters. We don't really accept any kind of substantive changes to our letters. We have a value proposition. It works. We have great client references. We have repeat clients as a result of that. And so we're really focused on delivering a world-class outcome for our clients.
That's good. Yeah. So when it comes to like due diligence and speed to market or speed to execution to help your firms, win deals, or your firm win deals, what does it look like when you get a pitch deck, right? And you get the financial report? What are you looking for? Is there key aspects that say, oh no, this is a pass, hard pass? Or is there key aspects that say this is a winner here?
Yes, usually it's a very basic set of metrics that has to pass the first test. So revenue growth rate, operating margins, their customer acquisition cost relative to their customer lifetime value, and their churn data, customer churn data. And the final one would be customer concentration. I mean, those are sort of the first like handful of metrics that we would look at. We don't want to see customer concentration with any one name greater than 10%. We wouldn't want to see the top 10 be, greater concentration than over 50%. We would want a customer acquisition cost, the customer lifetime value ratio to CAC, being 10 times or more, right? Revenue growth rate can vary depending on industry, but we're looking for someone who's growing faster than the overall market. So if the market's growing 10, we want to see them 15 to 20. In the SaaS software, our clients are typically growing 35, 50% or more. Some of them are growing 100% year over year. So it just sort of depends on what industry they're in terms of where their best-in-class metrics should be. But we're looking for best-in-class metrics, basically.
Okay. So it's somewhat like the Shark Tank approach, or do you guys work with startups, or they have to be established for a certain period of time?
Yeah. So our advisory clients are mostly somewhat established, right? It's not really a great revenue gauge for our clients because they're tech. So when you apply a 10x, multiple to something, somebody can have, 30 million of revenue, and at 10x they're selling for 300 million. So we don't really look at revenue as much. We've sold companies, for 20, 25 times revenue. So when you do that, all of a sudden you've got a $75, $80 million deal, right? So we're really looking at just are they a first mover? Are they outpacing the market? Do they have something special? And in this environment, do they have something that will withstand the trends of AI? And so those are the kind of things that we're looking for. And the due diligence that we do around that is to make sure that we have that kind of branded outlier story to take to market. Yeah.
Awesome. So we've talked about the difficulty in, differentiating investment bankers and the importance of, trust and, where you're hiring an advisor. What differentiates you guys? Could you elaborate a little bit more on that from other advisors that are out there? Because I think that's very important.
Yeah. So I think one thing that differentiates us is the training and the pedigree. So the background that we come from, I would argue to say that almost any boutique that our team is put up against, if you go down through a checkbox and say, did they do large cap, bulge bracket, buy side M&A? That's what we do. Check the box. Did we do IPOs? Check the box. Cross-border deals? Check the box. Work with first movers in sort of breakthrough technologies? Check the box. So those are kind of all the things that we do. I think the other things that we do, as a secondary level is Tim has a legal degree and an MBA. I have an accounting background in an MBA. And so there's really no topic on the deal that we can't get our arms around. Of course, the lawyers and accountants are hired on our transactions. But if something comes up in terms of working through it, helping to solve the problem, I think we can be a very good bridge between the business side of the situation and the legal side. There's many legal issues that come up that are legal risk, but then there's the question of how does that translate to business risk? And I think that's where we can be helpful for bridging the gap, because lawyers need to protect their professional reputation of clearly outlining what the legal risk is. And sometimes it's not fair to ask them or good for them to venture into translating that to, okay, how do we make a business decision off of that, right? They're there to provide the best advice. They're there to provide the true legal analysis of the situation. But then there has to be a business analysis of what do we do, right? There's a cost trade-off to almost all of these equations. So I think that's one thing that differentiates us. I think the other part is our model is flipped upside down. So we're very top heavy. So in our deal team, 50% of the deal team will be managing directors and 50% will be junior people. And we staff like 6 people on a deal like anybody else does. But it'll be heavily weighted to have 2 to 3 MDs. And that's where the brainstorming and the creativity and the experience comes from, really tapping into all that background that we have. So I think that makes, quite a bit difference as well.
That's very cool. So when it comes to, working with MDs, do you work with, obviously, chief investment officers? When it comes to deal origination, are you, from your accounting background or perspective, are you assisting with the closing of these deals in terms of your succession fees? And do you sit directly across, the desk from these PE firms and principals?
Yeah. So one thing I'd say is that we are hired by the company, the seller. Okay.
Right.
And so the board of directors will basically hire us. And when we're working on the transaction on a day-to-day basis, we'll be working with the CEO and the CFO, the CTO, and the head of sales. Those will all be the people at the management team at the company that we will work with on a daily basis. But we're hired by the board. We report to the board. We represent all shareholders. When we take a company to market, we're looking for buyers. That buyer could be a publicly traded company, or it could be a private company. That company could be a private equity. The buyer could be a private equity firm who already has a platform investment. They're going to combine it, or it could be a private equity firm who just wants to make an investment in this sector. It's really all above. And we have to look at each and every deal to see what the applicable buyer universe looks like. If it's on the smaller side, the publicly traded guys just can't afford to dip down. So you might look at the very small cap companies or the private companies. There are certain companies that are going through a little bit of a transition or a turnaround. And so sometimes a private equity firm is a good solution to take them through that next round of growth before they think about an exit. We have entrepreneurs who don't want to exit. They just want to take some money off the table. So private equity can be a very good resource to help them put some cash in the bank after 10 years of running a company. But they want to stick around for another 5. And so the private equity was there to help them do that. So every deal is different. And of course, from the buyer side, whether it's a strategic publicly traded company or PE, we'll be negotiating directly with them.
Awesome. What about like family offices when they're looking to diversify their portfolios, or on the buy side as well? Do you work with family offices?
We call it family offices somewhat. I would say it's not as regular. I think family offices are becoming more sophisticated. I think they're becoming more interested in tech and understanding tech more. Historically, they were not. They were more comfortable with kind of businesses that they could, quote, understand and operate. And so we're seeing family offices get more interested in tech. And so we're seeing them, more often in processes, but it's a lesser weight. They typically are not as well organized. They typically don't move like a kind of a traditional private equity firm would move. And so sometimes, quite frankly, they're a little less competitive. They're also a little bit more conservative. They're managing generational wealth. And so protect wealth is really important. They're not looking for 10Xs. So they sometimes will maybe be a little less aggressive. So you have to really find something that's kind of the right fit for a family office. Usually if the family has some real strong background, like in logistics or something like that, where they have a lot of industry contacts or a lot of industry knowledge, then trying to find something that kind of fits that family's background and experience, that's generally the most winning combination.
Yeah. Well, very insightful. Stephen Day, ladies and gentlemen, thank you so much for joining us on the Growth Xperts Podcast, Stephen. And for those of you who want to check out his company, that's navidar.com. It is in the description below, and you can check Stephen Day out on LinkedIn and check out his professional profile and his background. Stephen, it's been a pleasure. Thank you for joining us.
Derek, thank you. It's been a pleasure.